Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good day, all. Ira Epstein of Linn Associates with your agriculture update, and this is for Wednesday, the 25th of April, 2018, about 1:25 p.m. Central Daylight Time. Grain markets, a nice bid today. Now, we know the farmers are in the fields. We know that they're going to be planting as fast as they can, getting caught up with that inclement weather that had put everything pretty much in many areas of the countries behind. But I've been through this. You know, I'm almost 50 years in this business, maybe a little more now. I'm thinking about it. And every year there's always a problem getting the crops in. Every year there's a problem that the crops aren't going to grow right. There's not enough moisture. And at the end of the day, it's the exception to the rule that things don't go okay. Just understand that. But obviously people want to build in premiums for certain reasons, and the what-ifs. What I really think the biggest what-if that is good for the grains, and why I think they're finding a, if you will, a trading bottom right here. I didn't say a trend change. I said a trading bottom in many cases, is the fact that the U.S. and China are going to talk. And obviously what we're going to talk about is trade, not how's the weather going there and how you're doing with North Korea. And if we can get over that hurdle, and we can get over other hurdles where we're not going to make our allies our enemies, the American markets aren't going anywhere for what we've got, and the president may end up with his good trade deal. It's scary. I have been in this farming community my whole trading career. I know how fearful it is for those in it. On the other hand, things can also get better. What if China and the U.S. do a deal, and now we secure a good trade partner that has to buy more of our product to get down that imbalance in our trade? Not a bad deal if the president can pull it off. I'm not saying all of today is about that, but I'm certainly saying some is. Yeah, I'll go on record saying that is once I heard that the trade deal talks were back on and a delegation's leaving from the U.S. Now, as we take a look and try to figure out where we're at, even with this break that we're getting, we're down 2.5 cents for the week. We've made up an awful lot of it. You're still staying over the 18-week moving average of closes. You're in a down thrust because you've gone from a high to a low close and broken through a previous pattern. But the bias stays up when you're over the 18-week average of closes. When we take a look at this correction, we had a reversal yesterday that had followed through today. And when you put it on with the swing lines, you still have a pattern of lower highs, lower lows. We have formed another trade bottom. That doesn't mean anything because you're looking for where the resistance in the market is when you're in a downtrend. And I define a downtrend as lower highs, lower lows. The resistance to me is 1048 3/4. The 18-day average of closes. So I was looking for support possibly at the closest of the 100-day average once you slip through there, or the Bollinger Band, and it came in very close to the two of those. I think you'd agree with that. Now, the resistance points. To break the current downtrend, two things have to happen. Number one, take out 1063 3/4 and close over that 18-day average of closes. The first step is going to be closing over the 18-day average of closes. I would expect you're going to see sellers there because the market in momentum is not oversold. So you have a market that is still in balance with a downside flow. The bias is down because you're under the 18-day average, and you've got a pattern of lower highs, lower lows. The meal negated that. The meal market went down yesterday, hit the lower Bollinger Band, and today came flying up. And if you take a look, today's high was 384.10. The 18-day average is 383.60, and you're settling at 380.70. Did what I teach operate? It did. That's all that I could say. You are oversold. I think that when the market was in the downtrend, you hit the lower band, you're oversold. Traders come out. The neutral spot on a chart is the 18-day average. It doesn't have to go there. But what it did do is it broke the pattern of the downtrend. You no longer have the lower highs, lower lows. I say you're in a sideways trading band looking for another piece of information. The market that is the weakest of the soy complex has been the soybean oil. Each challenge of the 18-day average since the beginning of April has faded. Yes, the market hits the lower band and manages to bounce away, but overall this market is just all bearish at this point. To negate the trend, you got to take out the 31.65 level, then you've got resistance at 31.75. I just don't see anything friendly on that. The corn market today got high enough to come out of the downtrend. And why were we in a downtrend? Let's go back a day if I could. There we go. You had a pattern of lower highs, lower lows. Momentum was down. This was Tuesday. We're at Wednesday. Remember that. Did the market get down low enough to hit a Bollinger Band? It missed it by a half a cent. I'll call it in the ballpark. So I think getting into this area here where the market's knocking on the door of being oversold, didn't hit it, by the way, knocking on the door. Now the question is, what next? What would break the downtrend, even though you didn't hit the downside targets, is taking out 392.5. And what I mentioned yesterday and the day before was I don't think there'd be willing sellers at that number. The reason, the market would then have a pattern of a lower low and a higher high if you hit that number. And lo and behold, that's what happened, and I think you've gone back to neutral. Momentum's trying to pick up a bit. The bias is up because you're over the 18-day average, and the market, I think, is void of trend. In the wheat market, it's the same thing, but this market made it stand against the 100-day average of closes. It did it in this zone before as well. And now you've got the higher high, lower low. I'm going to call it no trend again here, but you met some downside numbers. In the sugar market, it is still a collapsing market that goes hand in hand, as you'll so often hear me teach you, with the embedded reading. Now, you've got 2 days in a row under the lower Bollinger Band. The odds favor that tomorrow, day after, the market's going to try to move to the right-hand side of that band. That does not mean a trend change. It just means moving to the right-hand side. I'm going to assume it's getting harder and harder for the shorts to be pressing that market at the current price. The coffee's making a stand against the 18-day average of closes. You've got higher lows, higher highs. The settlement today over the 18-day average. Momentum waned today. Do you see how all of a sudden it turned back? Something to be cautious of, and the risk in this market is not fun. Let's assume you were to buy it at the 18-day average. If you put a stop under the recent low of 115.70, you're going to risk 3 cents. 3 cents in that market's about $1,100. It's an awful lot to have to risk on a trade. In the cocoa market, you keep going to the upper Bollinger Band and failing on these tests of it. I don't see any difference this time around than the other. The trend is up. The market is overbought. It has hit upside targets. In the cotton market, drought, drought, drought. A lot of Texas cotton is and will stay irrigated, but there's plenty that isn't. And when I was looking yesterday and seeing how the USDA reports were coming in, I thought the market looked a little friendly there. Somebody else saw a lot more than I did. I admit I am no expert on this, but now you just see a market that's waffling back and forth against the 18-day average of closes and the upper Bollinger Band. I'd be very cautious on a move to that upper band. This market has continually offered resistance hitting that number, so I don't think any difference there. Cattle's not trending. You have a lower low and a higher high. However, remember what we did say. We were looking for the barbecue season, the weather to pick up, and eventually that beef demand to come back. And I have no reason to think we're not knocking on that door. We're going to be near 80 in Chicago this weekend after just being in the 30s a couple of days ago. Yeah, days. I know I went to work this morning, it was in the 30s. So that gives you an idea. The change is underway right now. When you come to the feeder cattle, we know that the market backed off yesterday, but right back up today. The resistance is crystal clear. It's the 100-day average of closes in the upper Bollinger Band. Can it break through that and run? Of course it could, but it hasn't. And I think that's where you're getting longs taking money off the table. What I'm watching, of course, is the embedded readings. Look at both numbers today. Both numbers are over 80. Both numbers over 80 on Tuesday. Both numbers over 80 on Monday. Friday, you got a fully embedded reading. Until the red line gets back under 80, The breaks in this market should be well supported. At least that's the theory that I use on embedded readings. When I look at the hog market, I see no trend. I've got a higher high, a lower low, momentum down, bias down, but the real battleground is going to be this 18-day average. Notice how you fell apart today and then you rallied back late in the day right to that number. Expect that to be the problem area of this market for a short while. Now, one of the things that we use in the office, and you might want to learn how to do it, it's called a pivot point, and it's aggressive. When I'm looking at a trade that I've already put out in my nightly recommendations or my morning, I sometimes look at a pivot point to see, is it closer than one of the points that I'm telling my clients? Yeah. And what it is you're looking at the high, the low, the close, and there's a formula, and it's very popular. It's used by a lot of traders. And as you can see, it's looking, for example, at parts of it, you're going to use the previous day's high, low, close. You're going to add them together, and then you're going to come up with the formula. The formula is going to give you the pivot point itself. I'll show that in white. You're going to get 2 resistance points above the market, 2 support points below the market. You're trying to come in at those resistance or support levels and trying to come out at that pivot point often. It's another way to look at a market. And if you look at it in the way that a lot of traders use it, you start getting a feel for what's going on with the trade. Of course, I can use oscillators with it and some of the other tools. But the most important part is learning what some of these other tools that you may not have in your arsenal are. And yes, if you've got a popular charting service, it's already included in it. So I've put together 2 videos to teach you how to use it. Give us a call. You can go to our website to sign up for this, by the way. We've created everything to send it right out to you with the links and all on our email. Right through here, you can click if you're watching me on YouTube or under us on a bunch of websites. It'll say click here for Ira's free information. I'm Ira Epstein. Thank you for watching, and I'll see you all tomorrow.